So right now we're due for a correction. We've got a pretty decent deviation above that 20-day moving average. We should get a sell-off over the next week, maybe two, that retest that 20-day moving average at least. A retest of the 50-day moving average would be about 4.5%, so close to 5%. Again, back to complete normality again, so it wouldn't be surprising. So I would kind of continue to expect little short-term corrections back to the 20-day moving average. If you're needing to add exposure to your portfolio, I wouldn't do it here. I would wait for this market to kind of cool its heels a little bit, work off some of that overbought condition.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here again at the end of another week for another weekly market recap with my good friend, the Tintinabular, Lance Roberts. How are you, Lance?
I'm good. What happened? Did you get kicked out of your house or what?
Well, I am out of my house. My wife actually is here somewhere, not just in the room right now, but I'm actually out on my old stomping grounds for my origin in my financial career. We are down in Wall Street here in New York City, literally just a few blocks from the memorial for the World Trade Center. I used to work in the World Financial Center when I started off as a very junior investment banker for Merrill Lynch. Walked through those old stomping grounds yesterday. It was a little bit of a trip. But I'm actually here because I will be part of a group that will be ringing the closing bell today at the New York Stock Exchange. There's a company called Tidal that is an ETF creation company, and they've invited me out along with some other financial media influencers. So we have Daniela Camboni, we've got Jay Martin, we've got Michael Guyad and David Lynn. It should be really fun. I've met all those folks for the most part separately throughout my journeys here, but we've all never been in the same room together. Should be really fun.
Oh, that's awesome.
Yeah, it's very cool. But lots to talk about this week. Kind of a fun, not rant, but positive story I want to get to that sort of ties into this New York journey. Real quick before we do, a couple quick things. One, Tintinabular, for those that aren't familiar with it, means of or relating to the ringing of a bell. So given the fact that we're ringing the closing bell, I thought that would be an appropriate descriptor for you, Lance. Also, last week, we finally did our long-awaited walkthrough of your firm's newly launched, new and improved version of SimpleVisor. And man, Lance, the response to that was tremendous. So congratulations again on launching a really fine and very impressive service there for investors, both those that work with you for, having their accounts managed, but certainly for the armies of DIY investors, many of whom watch these videos. Just gotten nothing but great positive feedback. Saw a lot of interest in the service. Just want to mention it again here because, folks, if you didn't watch that video and you are a DIY investor or you're just interested in learning about more tools that can help you understand what's going on in the markets better, help you sort of inform your decision making on how you want to make your investments, go back and watch last week's video and go search through watch through the SimpleVisor section of it. It was wonderful.
Yeah, I appreciate that. And we got tons of really great suggestions over the course of the last week that we've put up on the whiteboard, and literally we have a whiteboard that we write these ideas down on. But there were some really great ideas, some suggestions that we're going to be starting to talk about implementing as well. So because we're going to, this is, kind of a rework of our original platform. We've added a lot of tools to it, and we've got a lot more coming. But we have to, it's always one of those development things. You just got to pick a point that you put it out there, and then you start doing version 2, version 3. So a lot of really great ideas are going to come in, and we appreciate the suggestions and always welcome those. We'll always respond to them. So yeah, if you have good suggestions, we'll certainly try to incorporate those if we can. Some of it depends on data availability, like can we actually get data for it? But there's a lot of really good suggestions. We're going to improve those, and we've got a lot of new stuff coming that again, all the model portfolios and things, those should be up here in the next few weeks, we hope, as we just kind of finish up our work with Fidelity. So looking forward to that as well.
All right. Well, as new features roll out, obviously please keep us updated here,
Sure.
in these weekly videos, so folks know,
Absolutely.
everything that's new. I love the fact that your development pipeline does involve consumer feedback. I did a lot of product launching back in my days for Yahoo. And I always found that we always had the best success if we just kept our ear to the ground and just listened well to what our end users were telling us. And it sounds like that's how you're going to sort of prioritize the roadmap going forward.
Well, yeah, I mean, we have our ideas, like we think this is cool, but we've developed tools in the past that nobody used. We thought they were great tools, but nobody used them, so we scrapped those. And again, we want to provide a tool that is something that people are looking for, right? And it's like, oh, I never had access to this thing before, whatever it is. That really helps me. So if we get a lot of the same comments, those are obviously going to get pushed to the top of the list. Kind of random one-off comments is, hey, can you build a special indicator for this? It may not be a priority, but if it's a good idea, we'll certainly look at incorporating it. But that'll just help the site better for everybody.
All right, cool. We're very excited to see how that evolves over time from here.
Yeah.
All right. Well, look, I've been a little challenged to follow the markets as closely as I normally do this week, as I've been traveling, and then the other day markets were closed for Juneteenth. We're recording this a few hours earlier in the day on Friday than we normally do, and that's because I've got to get to this the ceremony we talked about. Maybe when you get a chance, Lance, we might want to bring up the regular charts that we've
Sure.
been thinking up through. But I guess while you're doing that, one of the headlines that caught my attention while I was traveling this week, just because it sounds like it could potentially have a lot of ramifications going forward, is the story about the Japanese bank, and I'm probably going to murder the name of it here, Norinchukin Bank.
Yep.
Okay. Where, as I understand it, pretty large bank in Japan, and they're beginning to, basically stumble under these higher for longer rates, and they are essentially deciding, hey, what we got to do is start getting rid of some of these treasuries that are sitting on our books, that are currently right now underwater, and then maybe using those proceeds as well just to shore up other parts of their balance sheet. And people are worried about, sort of a contagion starting of mass selling of US treasuries.
Oh, Jesus, again, we're back to this again.
Yeah, well, I don't know. I mean, I knew people would probably have this question. So
every time somebody sells something, it's like, oh my God, this is the beginning. Just,
well, I guess the question is there much there to this story?
There's not anything there to the story. Look, if they dumped $86 billion in a single day, sure, that would probably ding the treasury market a little bit for a day or two. But when you start talking about $86 billion worth of treasuries, and look, it sounds like 100,000. It certainly sounds like a lot just on the surface, but that is 0.0025% of the entire treasury market that's just owned by the federal government. Right. So that's just the federal debt, 34 trillion in treasury debt sitting out. That's just the federal debt. That's not all the other treasury debt that's sitting out there. So you're talking about if they liquidated the entire position, it's a very fractional share of the overall treasury market. So again, it's supply and demand. And right now there is plenty of buyers out there for treasuries. So if they want to liquidate treasuries at this particular juncture, at this moment, there's plenty of buyers sitting out there ready to buy them.
Okay. So this is not something that you're worried about yet at this point.
No, it won't be. It's not. It's literally not enough to move the needle. Again, it's like saying, oh, we've got a hedge fund that's going to sell, $1 billion worth of NVIDIA stock tomorrow, right? It just doesn't move the needle because there's so much volume and transaction and so many shares outstanding in terms of dollar volume, notional dollar volume. For NVIDIA shares, that it might ding the price of NVIDIA for 15 minutes, but again, it's just you got to always keep this stuff in retrospective. Yeah, these are headlines. It's like the whole just recently there was the whole Saudi petrodollar. They're abandoning there was no agreement, right? There was a handshake nod about 50 years ago about using the dollar for purchasing oil, but there's no agreement out there. So this whole headline story that lasted for about a week, I was like, oh, this is the end of the dollar de-dollar. This is the end of the dollar. Saudis leaving the U.S. dollar agreement that's been in place for 50 years. It's nonsense, right? Makes great headlines, scares the bejesus out of people, so they don't invest. They don't do what they need to do with their money. And that's the problem with all these really bearish headlines, is that all it does is scare people into not doing anything, and the rest of the world is simply going past.
Okay. All right. Well, we're going to get to in a little bit in today's discussion a new piece that you've put out, basically arguing that, or making the argument that there's been a permanent shift in valuations, which is sort of another counter, I guess we'll say, to the people that are out there saying, hey, we're hanging out, and we've been hanging out for a long time above historic means, that eventually there's going to be mean reversion. And believe your argument's going to be perhaps not as much mean reversion as people are thinking, because the baseline has been sort of permanently raised going forward.
Right. And that has a lot, and we'll go through all the reasons why. But again, let's go back to the very premise. So let's step back just for a moment, right? And talk about what our job is as individuals. And whether you have a financial advisor or whether you're a DIY investor, we all have the same mandate, which is that we need to make money today with our money. We need to make sure that our money is growing and that we're investing our capital in the right areas to grow that capital over time. And so the problem with all of these headlines that come running along is like, oh, did you see this headline over here? Hey, there was a headline out yesterday. We're going to start drafting women into the military. Okay, what does that mean, right? So we can take these headlines and we can start making very bearish arguments about whatever narrative we want to create. And generally, when you see a lot of these narratives, the end of the dollar, whatever it is, always be careful about the source of where it's coming from, because generally those people have a bias. They're selling gold, or they have some bias towards, they're talking their book, whatever it is. So I've got a big heavy exposure in precious metals and, kind of the doomsday bunker type scenario portfolios. And so they're just talking their book. So they need headlines to support that. And that's okay. I'm not saying there's anything wrong with that. Just always be aware of what the reasons are that some narrative is being pushed, whatever that narrative is, bullish or bearish. And again, it's the same thing across the board. So, I mean, if some guy has, if Tom Lee comes out and says, hey, well, actually, let me rephrase that. Goldman Sachs just came out and said, hey, S&P is going to be at 6,300 by the end of this year. Right? That's their new price target for the S&P. Well, they have a narrative. What's that narrative? Their narrative is that I need to sell investment banking products, and I need to make sure that individuals are buying shares in the companies that I'm doing secondary offering in, that I'm doing investment banking in, whatever it is, because Wall Street's priority is institutions first. Corporations are right there at first, so we could just flip those back and forth, first and second, but corporations and institutions are first and foremost on their list. The retail investor, after you get past pension funds, other mutual funds, insurance companies, the retail investor is at the very bottom of the list in terms of being important to their overall outlook. The need for Wall Street, for the retail investor, i.e. you and me, is that they need somebody to sell all this stuff too, because we're the end buyers. At the end of the day, if a pension fund wants to liquidate 100 million shares of some stock, they push out a story. The analysts come out and say, hey, this is a great company. It's a buy-rated stock. Make sure you buy it today. And you're the end buyer. So always be aware, bullish or bearish, what the narrative is. And you got to step back from all that. And that's what we spend a lot of time here. You and I, Adam, this is what we spend a lot of time on Fridays about, Saturdays, talking about these narratives and saying, look, here's what's happening in the markets. And our job is to make money today. And we've got to make money today. We've got to make money tomorrow. And we've got to avoid those big downturns. And so that's why we spend a lot of time looking at the technicals. What's the market telling us? Set all those narratives aside. Just pay attention to what the market's doing. The market's always going to lead you in the right direction. The market is a fantastic leading indicator. We did a whole report on this probably 2 months ago about the leading capability of the market for economic growth, recessions, whatever you think the dire outcomes are going to be, the markets will tell you well ahead of time before that happens, and give you an opportunity to reduce risk. So, I'm not sitting here promoting that you should just buy and hold stocks, because that's not investing. That's not managing your money. But, be careful of these big narratives, bullish or bearish, because they get you off track, and you wind up, making bets that wind up either losing you money or losing performance in the markets. The markets are up almost 13% this year. And just a good example, everybody was piling into T-bills. I can get 5% in a T-bill. That's great. The market's almost tripled your return this year over T-bills. And so why do you own T-bills? I mean, I do too. By the way, they're a portion of one of our portfolios. But why did you put all your money into T-bills? Nothing wrong with it. But this is the trap that we get ourselves into by not paying attention to what markets are actually doing versus these narratives.
All right, great point. I'm sure we're going to continue to make that point again and again and again in this channel, because I'm going to keep feeding a lot of these headlines of the week, obviously, because we want to know, hey, is this something that we really do need to pay attention to, or is this just something that's getting the herd to momentarily chase in one direction and then they're going to reverse? All right, so listen to what the market is telling us. I'm going to let you drive through the chart here, but just quickly glancing at it myself, from, we do this every week. Looks like short term, the market is still telling us that it's in overbought territory.
Yeah, no, it is. And look, so caveat real quick on this chart. As Adam said, we're doing this very early on Friday morning. In fact, as we are recording this right now, the market is not even open yet. So what I'm about to tell you is really about Thursday's close. And this Friday, today, as we are recording this, is options expiration day. And the third Friday of every month, all options, well, there's what we call triple witching and quad witching, but we have options on stocks, options on futures, options on markets, etc., index options. So the third Friday of every month, options expire, and they have to be either rolled over or sold or replaced, whatever it is. And that causes, as the options expire and have to be rolled over, this causes a lot of selling or buying in the underlying securities. And so today there is a $5.1 trillion option expiration. So in other words, $5.1 trillion are all expiring today and have to be rolled over in some form. So as we're talking about the markets right now, I have no idea how this is going to play out. This could be a day where the market starts out weak and ends up very strong. It could start out strong. Right now, it looks like we're going to start out on the weaker side this morning. We could get a lot weaker. We have gone 334 days now, which is a very long stretch, without a 2% correction in the market. So in a single day. So it's been a very long stretch without a 2% down day in the S&P 500. So maybe today is the day. We have, $5.1 trillion worth of options expire. Requires a lot of selling in the underlying security, because everybody was, long NVIDIA or short NVIDIA, whatever it is. So that's all got to be worked out through the options market. So Friday, we could have a whole lot of volatility up or down, and it'll mean very little to the market on Monday. So don't take Friday's action and try to interpolate anything about it, because we have a very kind of a unique situation happening today. We've had these big volume days before on options expiration, and generally they kind of reverse on the following Monday of whatever happened. So just that's the big caveat. So right now, though, to your point, Adam, the market is very overbought, and we're very deviated from the 50-day moving average, which is that blue line. And so we have to go back a little bit. Adam, you and I were talking back in March that we were due for a 5 to 10% correction in the markets, because the reasons were the market was very overbought. The deviation from the 50-day moving average was pretty extreme. And there were some other kind of technical indicators that were out there that were suggesting that a correction was possible. So, and then of course, in April, we got a 5.5% correction. Tested that gold line, which is the 100-day moving average, held, rallied to the 50, failed, tested the 100-day again, and and then rallied from there. Now, it was important that we came down, we tested the 100-day moving average. When we rallied and failed at that 50-day moving average, that was concerning, right? Because again, at that juncture, we now have a failure at previous support that had the market taken out the 100-day again, when it came down to retest the 100, if it had failed there, then we would have gone down to test the 200-day moving average. That would have been about a 10% correction. So that's how that 5 to 10% correction kind of range was occurred. Also, a 5 to 10% correction is completely normal in every year. In every single year, you have 5% corrections. In every other year, you have a 10% correction on average, right? So, you might have 2 years in a row with a 10% correction, and then 2 years without it, and then another year with it, right? So it can be sporadic, but these 10% corrections are completely normal. They happen all the time. 5% corrections happen every single year, for the most part. So, fortunately, we rallied 5.5% correction. We rallied, got back above those moving averages, flipped back onto a buy signal in early May the 3rd, triggered a MACD buy signal, and then we've had a very nice rally ever since. So here we are once again, very similar to what we had seen back in really January, February, March. The market was rallying along that 20-day moving average. That's that red line that was providing intermediate term support or near-term support. And so right now, we're due for a correction. We've got a pretty decent deviation above that 20-day moving average. We should get a sell-off over the next week, maybe two, that retest that 20-day moving average at least. A retest of the 50-day moving average would be about 4.5%, so close to 5%. Again, back to complete normality again, so it wouldn't be surprising. But I would kind of suggest, I would kind of think, we talked a couple of weeks ago that, the market was, and look back over here, it was around May the 15th. You and I were talking about, hey, we're pretty far above these moving averages. We'll probably retest that 20. Exactly what happened. We've rallied off of that since. So I would kind of continue to expect little short-term corrections back to the 20-day moving average. If you're needing to add exposure to your portfolio, I wouldn't do it here. I would wait for this market to kind of cool its heels a little bit, work off some of that overbought condition. If the MACD indicator flips back onto a sell signal, that might suggest a little bit deeper correction. We'll see. Again, we kind of had that signal, back here at the end of May. We had a sell signal. That's where we retested the 20, flipped right back to a buy signal, and then we've been up since. So I would kind of expect that same type of market action to continue to happen here through July into August. The best opportunity for a bigger correction in terms of maybe thinking about that 5 to 10% range would most likely be somewhere around September, October, before we get into the election.
Yeah, and you've mentioned that several times before, that's the likelier time frame for something larger. I've been tracking the presidential polls relatively closely, and man, they're tight. I just looked at them before we hopped on here. I mean, there's basically like I think only a 1/10 of a point between the candidates right now, at least at 538.com. So, I know that we both were sort of hoping like, hey, whoever wins, we hope that it's sort of a landslide victory, just so we don't have as much chaos and division and
Good luck. Good luck with that. I think we're gonna have a whole lot of chaos and division no matter who wins. So
probably, but right now it's looking like it's going to again be a nail biter, which is, I think, bad news for everybody, especially markets who don't like uncertainty, right?
Yeah, and the problem with polls, 538, a great organization, right? But they're very left leaning in their analysis. So you've always got to be very careful with these polls. Again, these polls have been historically very wrong a lot of times. Just, be careful when you look at, like, if it's the Wall Street Journal poll or if it's an NBC poll, whatever it is, always consider the source of where it comes from and kind of where their leanings are. Because, I can take other polls that lean right, and they have much bigger spreads between the two candidates. So again,
I agree with you, and it's back to your sort of consider the source. I will say this morning I did dial through a bunch from different sides of the equation. They have all tightened.
They have absolutely all tightened. There's no doubt about that. And you know, this is why, you know, there's I think real clear politics, if I'm not mistaken. I haven't been to their site in a while, but I believe they provide like an average of a whole variety of polls. Like they take both left and right and they come up with an average. And that's probably, you know, I don't have time to do that type of analysis, so, and nor do I really care. But, you know, if I was going to try to really understand where we are, I'd try to get maybe 10 left leaning polls, 10 right leaning polls, run a statistical average, run a mean and a median, and try to, and that would probably give me a better fit as to what to kind of expect out of the election process.
All right. Well, right now it just seems like, given the data that we have, we should strap in the closer we get to
Yeah.
November, because as long as it remains this tight, the uncertainty is likely to be a lot higher. Obviously, as you said, that doesn't translate well into happiness for the markets, and people might be selling off more than normal the tighter the race is going in.
Well, it's also a function of policy, right? So, I mean, you've got, you know, President Biden talking about if he, you know, if he gets another term, he's going to be talking about higher taxes. You know, he's going to tax the rich, you know, higher corporate taxes, you know, capital gains taxes, less immigration reform. You know, which, you know, right now, as we've seen with the employment polls as of late, we've seen a lot more foreign-born workers being hired than native-born workers. So we obviously have an immigration issue relative to our employment structure. You know, on the other side, you've got the other candidate saying tighter immigration policy, lower tax rates, even floated the idea of getting rid of personal income taxes in exchange for tariffs. Horrible idea, but that's the differential between, you know, the two policies. And so the problem for Wall Street is, with tight polls in particular, is that I have no idea who's going to potentially win. And, you know, one maybe is a good tax situation, one may be a bad tax situation if I'm Wall Street, where, you know, I depend a lot on capital gains and pass-through taxes and those type of things, pass-through gains, et cetera. So, you know, I might want to de-risk going into the election, just because of the sheer uncertainty of what policy I'm going to wind up with. I can, you know, if Trump gets elected and his first day in office, he cuts taxes, I can add positions to the portfolio, right? But, you know, if Biden wins, all of a sudden taxes go up, you know, I'm kind of in a bind on kind of where to go. So I wouldn't, this is why it wouldn't surprise me to see Wall Street really kind of de-risk. And again, we're not talking about a major crash here. So don't take what I'm saying and extrapolate like, oh my gosh, the market's going to fall apart. But no, I mean, just simply that 5 to 10% correction possibility is more likely, simply because, hey, you know what? I've got huge amount of gains in NVIDIA right now. You know, so why not take some of those off the table and not worry about it, right? Because I know if I take them off now, I'm going to pay 20%, you know, cap gains. Why worry about it? So,
and yeah, that's actually a good point on the cap gain side. Given the uncertainty about the difference in policies around capital gains, the two contenders. Is it fair to say that the tighter the race is going into November, you think the tighter the race looks, the greater the odds will hit the higher end of that correction range? Because Wall Street would increasingly want to de-risk if it doesn't know which way it's going to go.
Yeah, I mean, I think that's the risk, right? You know, out of all the risks that everybody talks about, I think that's the biggest risk. And if we just kind of build that into a normal corrective structure, again, if you correct from where we take a look at the chart, if we correct from where we are now to that black line, which is the 200-day moving average, that's about 10%. So that's how you get that 10% range. And that's a very reasonable correction. Remember, we had a 10.02% correction in last summer. You know, people thought it was the end of the world. It felt terrible, because whenever you have a market like we have right now, and this was the market that we had last year. So remember, in January, February, March, April, May, June of last year, this market was just traveling higher. We were up 17% for the year going into June. It was all about artificial intelligence. Those stocks are rocking. Complacency is extremely high. Bullish sentiment's very high. Allocations to equities are very high. Everybody's completely complacent with the market. And then you had this 10% correction, completely normal, right? But people were, you know, I was getting swamped by emails. It's like, oh my gosh, I'm losing all my money. Okay, you were up 17%. You're down 10. Let's, got to keep things in perspective. But, when you have a very complacent market like we have right now, these corrections are very painful, right? And because like right now, nobody thinks we can have a correction at all. Even that 5% correction we had back in April, I was getting emails like, "Oh my gosh, is this?" It was like the old Sanford Sundays. "Oh my gosh, Elizabeth, this is a big one. I'm coming." You know, and it was a 5% correction. Completely normal. So again, and this is why we always suggest managing risks, taking profits, rebalancing portfolios, those type of things. Because if you do that gardening process, then these corrections have much less impact to your portfolio. Where this hurts is where you've been piling into NVIDIA all year. And now you've got a big weighting in NVIDIA because you think it's going to the moon. That stock's going to correct 10, 20% very easily. And it's not even going to break its bullish trend, but it's going to have a very easy 10 to 20% correction. And you're going to lose your mind and you're going to wind up selling the stock at the low when you should be buying it, right? And this is that psychological cycle that we always get ourselves into. So if you just manage that exposure risk, manage your gains and losses, then you'll be able to weather these opportunities as they occur. And when the stock does correct, say, hey, here's a great opportunity. I can start buying some more of this. And this is what we did earlier this year. We sold NVIDIA. And then during that dip in April, we bought more back and, so forth and so on. So, that's just the portfolio management process. You should always fall back on those rules. Have a very very clear set of investment rules and a discipline and follow those. And really, you'll be a much better investor. If you just turn off all the other noise and just pay attention to your investment rules, you'll do way better over time.
So, we've mentioned that a lot, and I just want to underscore it again here because I just the other day recorded an interview with a fellow named Jim Dahl who runs the website, the White Coat Investor. He's an ER doc, and he realized something that I've known for a long time, given my family being a family of healthcare practitioners, is that doctors and other highly trained professionals are very smart people, and they work really, really hard to become high income earners. But the programs that they go through, while incredibly rigorous in their craft, they don't give them any like a lot of doctors are expected to go out and run their own practices, right? They don't get any classes in how to run a business, right? They certainly don't get any classes in financial management or investing saying, hey, you're going to be a high income earner. Here's how you should protect and grow the money that you're working so hard to earn, right?
Yeah.
So he created the site White Coat Investor, and it was a really nice practical interview where he just was, laying out there's this brass tacks about wealth building over time as an investor. And it just very much echoed a lot of the conversation that we've had, Lance. And really, it's like, look, if you can be a successful DIY investor and really entrench those practices, many of which you just mentioned, into your investing process, great. They're not super complicated. It's like getting into shape. The science isn't really all that hard about what you need to do. It's the commitment and the discipline that's hard, not getting knocked out of your routine by the distractions of life and things like that, right? And this is where I think if you're honest with yourself and say, look, I don't have a great track record of doing that, that's why you want to work with a good financial advisor, because they are bringing you that discipline. You can leverage the commitment and discipline of a professional in this space. And yes, there's stuff you and your team and other financial advisors do that can be a little maybe wonky to some folks. It's a little bit of higher order stuff, but I would say the vast majority of what you guys do is just, a good execution of sticking to the knitting of time-honored best practices for building.
Yeah. Well, and it's very interesting. So, first of all, I can't tell you how many doctors I've had as clients over the years, because they are the worst investors ever on average, right? I mean, if you take a pool of investors and say, real estate people, lawyers are pretty bad too, but lawyers, doctors, they're really great at the profession, but they're terrible investors. They just do all the wrong things. And it's always very interesting, right? It's just, these are some very highly educated people, and, they just do everything you could possibly do wrong. They figure out how to do it. And again, I'm not, this is just my general experience of, hundreds, if not thousands of doctors that I've worked with over the last 30, 35 years.
Keep
But,
talking, because I'll tell you, Jim agrees with you, and he actually lists out the reasons why. So
yeah.
finish you, and then I'll share those reasons.
But yeah, it's very interesting that, when we get into a market like we're in now, and again, when I say the market like we're in now, this market like we're in now began in 2009. And it's not surprising that there's so many people that, oh, I'm a do-it-yourself investor. I love doing this. Yeah, because you're gambling. And you love it right now because you're buying a stock and it's going up, and you're buying Nvidia or Tesla or whatever you're buying, and it's going up and you're making money. We all love gambling when we're winning, right? And I mean, you put me down at a table in Vegas, and you deal me straight blackjacks every single hand, I'm going to bet heavier and heavier and heavier every time, and that's going to be an awesome night in Vegas.
Right. And not only you're going to have a good time, but you're going to think you're the world's best gambler too through that.
Absolutely right. And that's what the market has done to a lot of people who think they're DIY investors. And unfortunately, what happens, and again, I'm talking to you with 40 years of experience, that, crash of 87, 2000.com crash, 2008, 2020, 2018, people who thought they were a DIY investor figured out they're not DIY investors because they wound up losing a tremendous amount of money. The other class of people that fall into that is people that say, I just bought it for the dividend. Right? I buy stocks. I'm a dividend buying stock guy. I have a portfolio of dividend yield. That's great until you have a financial crisis of some sort, or some type of market downturn where not only do you lose 50, 60, 70% of your equity portfolio, and you're like, it's okay, I'm still getting the dividend. The problem is in those downturns, all those companies cut their dividends or eliminate them entirely. So now you've lost 50% of your value, and now you have no dividends. And so all those dividend models go right out the window when that happens. And this is why it always goes back at the end of the day. Now, look, we run a dividend equity model. We run growth models. We run 100% equity models. We run aggressive growth models. We run all those models. But every one of those models will fail at some point if you don't manage the risk. And that's the big important lesson you've always got to remember coming out of this is it doesn't matter. There's tons of very successful investment strategies, and dividend yield, growth yield, value, whatever. Some will underperform in some years. If growth is in fad like it is now, value underperforms, right? And so what do we do as investors? Well, we get our value stocks and we go buy growth stocks, right? And there we go. We're off our discipline. We're not following our practice. And then we get greedy. And then when the market downturn comes, we lose a whole lot of money. And then people do the next worst thing, which is, well, this whole investing game is rigged. I'm just out of it altogether, and I'm just going to go do back to whatever I was doing. And then the market runs up, and then they start going, well, I'm going to get back in. And I'm getting a lot of these emails as of late. Lance, I really like what you do. Email me when the market crashes and I'll get in.
Yeah.
That's not how it works. Right? Because even if the market crashes, you're going to say, see, I was right. The market crashed, but it's going to keep going lower. And it's going to start going up without you. And then you're going to start making every excuse in the world why it's going to crash again. And you wind up just never getting in. Yeah. So it's always our psychology at the end of the day. And this is why it's so important to manage risk, manage your portfolio exposures, all those type of things.
Yeah. And we talk a lot about how really at the end of the day, for the vast majority of investors, particularly retail investors, it's themselves. It's ourselves that are the biggest challenges to our success, right? It's because of the human emotion side of things. Speaking of the psychology, you and I talked a few weeks ago. We kind of got on this philosophical waxing of the importance of relationships, both around money, but just in general. And it asked the audience, hey, do you want us to create some more content in this space? And that was another example, sort of like Simplivisor, where the response was really strong and positive. So folks, just want to let you know we heard that, and we will be doing more of that in the future to try to bring more of the psychological aspect in, and how we can manage the worst parts of ourselves going forward, both in money, but in other forms of important life wealth, like the quality of our relationships. Just real quickly, because I mentioned it, Jim Dahl said doctors and professionals tend to be really bad investors because one, they tend to be overconfident, right? They tend to say, look, I'm a really smart guy. And they just assume that being really smart in one field means you're going to be a really good investor too. And so they kind of walk in with too much of a hubris about their level of ability as investors. They also think that they're somewhat invincible, right? And it's not a huge shock, right? I mean, to be like a really good surgeon, it's the profile is very similar with like a fighter pilot, right? You have to have a lot of overconfidence in a sense that you're different from the rest of society and that, you know, you make less mistakes and all that type of stuff. And one of the things he said that they tend to be, high earning professionals tend to be really bad at, total self-sabotage, is insurance.
Yeah.
Because they just don't think about a point in time where they're going to be vulnerable, right? It's just not in their training and makeup, right?
Right.
Yeah, you're smiling and laughing as I'm saying a lot of this.
Well, because you just reminded me that pilots are also another group of the worst investors.
um, ignorance, and I'm trying to remember what he meant there, but I think what he meant there is just this is stuff, like I said earlier, that they're just not taught. And they don't want to admit to themselves that they don't know something. So they kind of try to fake it till they make it, right?
Yep.
And making a lot of unforced errors along the way. But then the other one, which I think you mentioned once or twice, but it's worth underscoring, is you said they're also heavily targeted, you know, by Wall Street, right? So Wall Street looks at them as these, you know, fat wallets to go after. And so, you know, they've got Wall Street knocking on their door, whispering in their ear, hey, because you make this much, you get these special opportunities, and
Yep.
boy, I can get you in this deal that the average person can't get into, but man, it's going to be great for you, right?
Yep.
And they just get fleeced along the way, right?
Yeah. And we've talked about the dangers of private equity, you know, and that's one of them, right? So, you know, private equity firms and people promoting private equity funds of different types, real estate in particular, real estate deals are a really big deal. And so, you know, we're put together this private real estate deal that you're going to get in apartment complexes, whatever it is, and they target those high income earners because they can qualify as an accredited investor because they make enough money, right? So we have these if you don't understand that, we have what's called accredited investor rules. And in order to invest in there's a variety of these things out there, rule one, regulation D, you know, private equity investments, these type of things, these all require you to be an accredited investor. And basically it means you make $250,000 a year in income as a family, you make 300,000, and you've got $1 million worth of net worth. So in theory, and this really needs to be updated, because in theory, when that rule was kind of set in place back in, I think it was probably the 80s, $1 million of net worth was a lot of money. Today, if you own a house, you have $1 million worth of net worth in a lot of cases. So, you know, reaching that criteria to be an accredited investor and having earning potential of 250, that has gotten to be a lot easier just because of growth of incomes over time and high earners and houses and those type of things, because you include your house in that net worth. It's not your liquid net worth, it's your house including. And so it's really easy to make those qualifications. So all of a sudden, there's a whole pool of people out there that I can go solicit these private equity investments to. And look, they're good if you know how to evaluate what you're getting into. The problem with private equity, we've talked about before, is that you can get locked up in these deals when something goes wrong and not be able to get your money back for very long periods of time. And so you've got to really be able to, and this is the theory behind the accredited investor rule, is that if you're making that much money, you're smart enough to be able to evaluate your own risk. And when you get these documents, they're like this thick, and they have every clause in them, right? Because the SEC rule is disclosure, disclosure, disclosure. Literally, if I put in a document, hey, Adam, if you invest in this, there's a 99.5% probability you're going to lose every single dollar you have. As long as that's in there, whatever happens to the fund, I could probably even say, hey, Adam, put your money in here. I'm probably going to take 90% of it, not really invest much of it. If that's disclosed, right? The SEC rules are disclosure, disclosure, disclosure. As long as it's disclosed, you were supposed to read it, and you're responsible for making that decision to go into that investment. So the advisor can't really be held accountable because that was your decision. So the point is, look, I'm not poo-pooing private investments. They're okay if you understand really what you're getting into and what the risk is. Unfortunately, most people don't know how to evaluate that risk.
Totally agree. Let me ask you a couple questions here. One is, so first off, I think when this thing was started, the accredited investor rule, it was mostly, at least the way it was positioned, was to help the little guy, right? Like an accredited investor can afford, if this investment goes south, the accredited investor can live to fight another day. Where
Right.
if we let somebody with a lower net worth in, it could wipe them out. And so it's a little bit, I mean, it's maybe well-meaning, but a little bit sort of nanny state, like we know better than you. We're not going to let you get mad. And I know, some people have spun this to say, hey, they're just keeping all the good opportunities for the rich people. It's a way to let them get all the good stuff and keep us out of it. Over the course of your career, seeing people invest in these deals, maybe even investing in some on your own, what's your take on that? Like on net, are these good opportunities, or do people tend to lose more money than not in these things?
It depends on really kind of, there's so many different variations of these that, yes, some of them work. Like I said, if you can evaluate the risk, what you're going into, and really evaluate the opportunity, some of them work and some of them work very well. And, most of them don't, on a big chunk of it. And when I'm talking about most of them don't, it's the ones you're being presented. And the reason I say that is that there are massive private equity firms out there. Sequoia, you just kind of go right down the list. And they're the ones, if there's a really good private equity deal, as an example, Tesla, when it was private, right? They needed to raise capital to start their business, fund their business, et cetera. Well, did anybody knock on your door and say, hey, I got this private equity deal for this this electric vehicle company called Tesla. I know you've never heard of it, but this guy, Elon Musk, he's a complete nutbag, but he's a genius, right? So you should invest money. You never saw that deal because it went to these private equity firms and they funded the whole thing. They funded it once, twice, three times, four times, finally took it public. That's how they got all their money back. The really good deals are picked over by these private equity firms. So if a private equity deal comes to you, right, a private placement, and I say private equity, but it's not always, it could be private debt, it could be a whole variety of different things. If a company comes to you and says, hey, we have this really good deal in this particular deal, and they're coming to you as an individual, right? Ask the simple question, why am I so lucky? Why are you not at Sequoia Capital or a Bill Gates Foundation, whatever it is? These guys with billions and billions. The reason people go there is because I can raise all the money I need fast, right? I'm not having to go solicit $100,000 investments from 5,000 people. So if it's a good deal, why am I so lucky to be looking at it? That's the first question you should ask them. And if they can't, oh, well, it's our deal. We put it together. It's exclusive. Nobody else knows about this. Then why are you still coming to me? Why don't, if it's such a good deal, go to Sequoia, get it funded like that, be done with it, and move on down the road, right? Those are the logical questions you should just ask yourself. And look, I'm not saying that all deals are bad, so please don't think that. Just these are the questions you ask, and then say, okay, great. If they can give you a reasonable answer why you're so lucky, then say, okay, great. Look at the financials. Understand what they're investing in. If you don't understand the business, don't invest in it. That's number one. I don't understand anything about space exploration. I'm probably not going to invest in it, right? Sounds great, but there's so many things that could go wrong with that. And the second thing to understand is that when they present you the financials, these are the most optimistic financials you will ever see in your life. They're called pro forma. And these are, if everything goes right in the world, you're going to make billions of dollars on this investment. That's a very small percentage chance that everything goes the way they want. I'll tell you a good example. Just a few years ago, we were getting swamped with people wanting to do opportunity zone investments. And they were all out there saying, oh man, we're going to build this opportunity zone because you get tax credits for it. It's going to be awesome. We're going to fill this thing up and we're going to refinance this deal and you're going to get all your money back. A vast majority of those fell flat on their ass because interest rates went up and it completely screwed their whole cap rate adjustments, right? So all those deals that were supposed to be so good, none of those pro forma financials worked out the way that they thought they would because the Fed hiked interest rates. And those are the risks you've always got to be aware of, is that the environment you're in today may not be the environment you're in a year from now or 2 years from now. So you're going to see a lot of stuff about artificial intelligence and this and that and the other thing. And just understand that a year from now or 2 years from now, maybe artificial intelligence is the thing, but maybe we're on to something else, right? Maybe something else comes along that's even better than artificial intelligence. And all of a sudden, NVIDIA is not in the race anymore. So these things can, I'm not saying it's going to happen, but these are the things you got to be aware of, is that these investments that are generally presented as too good to be true generally are. So
Generally
always
are, yeah.
understand what your risks are.
And that's why I want to bring this up, because I know from surveying the audience, we've got a number of people watching this who are high income earners and high net worth and are getting these types of offers. So yeah, just a couple of things that you mentioned here. One, one of the main reasons why I asked this question was the adverse selection issue, right? Which is, okay, I'm a professional in this space. Why is this guy coming to me about this deal that I have no real familiarity with, but it's such a great deal, I should part with my hard-earned money to invest in, right? And I live out in San Francisco Bay Area. I went to Stanford Business School. I know, a fair amount of people in the VC community. And even just in the VC community itself, there's this adverse selection issue where they're the Sequoias of the world who everybody goes to them first.
Yeah.
So they get first pick of all the good deals. So by it's sort of like the top 5% of the VC industry just leans back and has all the great deals come to them. The other 90% are scrambling for the scraps that Sequoia and the rest pass on, right? So the deal's not even coming to you until it's past that 95%, right? So it's kind of like, why is this thing not fully funded by the time you're bringing it to me, right? Again, doesn't mean they're all bad, but you need to sort of be asking yourself, is this really a great deal for me, or am I a great opportunity for you to give you kind of the dumb money here to get your deal done?
Now, and look, let me give you a caveat, right? I mean, I do private investing personally. I do outside my firm. I do private investing, but I do private investments with people that I know very, very well, right? I know their families. I know their kids. I know where they live. If you know what I'm saying.
They know that you're a trained
exactly. But no, I mean, I have very deep relationships with the people that I work with. I've known them for years. I understand the things that I'm investing in very clearly. I have direct contact with the players that I deal with. So, I mean, if there's ever a question, a change in the marketplace, whatever it is, and I structure very strict deals, right? If I'm going to give you money, I want liquidity options. I want my return to be above what the market's giving me, all those type of things. So there's still things that can go wrong, mind you, right? And there are certainly things that can happen that I could lose money on. So I also make sure that I, weight those investments relative to my overall portfolio, so that if something, and this is the way you always think about it, is that if I'm going to do a private investment, let's say Adam's going to do a capital raise for thoughtful money. He's going to blow this thing out. So he's going to raise $10 million. So he's going to go to everybody and say, hey, give me 100 grand and we're going to raise $10 million. We're going to blow this whole thing out. That might be a great opportunity. I haven't really thought about it, but maybe this could be something we could do, Adam. So you say,
million,
do this.
50 million.
Yeah. So, but what you've got to do as the investor is say, well, this sounds like a really great idea. I love Adam. I think he's a great guy. I think he's honorable. I think, I think I can trust what he's doing. I kind of understand his business model a bit. But when you make that investment, you have to make that investment just like you're going to Vegas. And if you go to Vegas, and you should go to Vegas with a set amount of money that if you lose it all, it does not change your lifestyle. Right. We hear about people betting a house, at Vegas, and literally their house, so you invest 50 grand or 100 grand with Adam, then if you lose it, it doesn't affect your retirement. It doesn't set you back. It doesn't change. It doesn't phase you. If you look at that 100 grand and say, man, if I lose that 100 grand, I'm done. Don't invest 100 grand into that private equity placement, because again, the risk are substantially higher than investing in the financial markets where you have liquidity options. Because again, nothing against Adam at all, but if I give Adam 100 grand, I'm not going to see that money for a year or 2 or 3, depending on how long his business plan is. There's going to be no return on that investment. There's going to be no liquidity options because he needs that money to operate and grow his business. I'm betting on a future outcome. And that future outcome could be longer than my time horizon. And that's where you've got to really weigh that in your portfolio allocation.
Totally agree. So you went to one of the other ones on my list here was the lack of liquidity in these private investments. You give them your money, the pro forma document gives you some timeline on where if everything goes right, they hope to hand you your money back plus more, right? But oftentimes it does not, it never plays out exactly the way it is in the pro forma. Sometimes it's better, but a lot of times it's not. But a lot of, we're seeing that a lot right now in private equity deals, right? Where people are like, look, get me out of here, and they can't, right? They're stuck in these things. So you definitely have to, it's got to be money that you are realizing like, look, I got to be able to deal without this money for at least as long as they're telling me, and I probably should mentally discount it by another like 25 to 50%, right?
Yep.
The other thing you mentioned briefly, but I just do want to underscore is, oftentimes, especially with these high earning professionals who are very busy and very focused on their line of work, the deal is coming to you in some space that probably don't have a lot of experience in, right? So I've looked at some deals that have come my way, and most of the time I've said, look, sounds interesting, but like I know there's great tax advantages that come along with investing in oil wells, right? And there are ways to get out there where you can buy an oil well, you can buy a percent ownership in an oil and gas venture. I've just stayed away from them so far because I don't have any experience in that space, right? Like I don't know if this particular opportunity you're bringing to me, which you say is great, is any good on a relative basis, because I just haven't been investing in this space enough to really know what's good and what's bad, right? And it's for a lot of people that the sums are high, right? So in other words, if you're using this as, okay, well, this will be my first one and I'll hopefully do several of these and get some experience, great. But that can be a pretty pricey way to learn if you've got no experience jumping into this thing. So, and generally you want to try to find some competitive advantage that others don't have. This may be partnering up with an experienced investor in this space who's willing to say, hey, look, I'm getting into this deal. Let me explain to you, Lance, why I'm getting into this deal. Maybe you can, invest along with me or take a flyer on this one, but I'm telling you, I'm explaining the deals that I'm into you so that by the time you decide you want to put some money at risk, you've at least seen 5 of the ones that I've invested in, and my criteria for picking why they're good or why I'm passing on the other ones. So definitely try to get yourself that unfair advantage. And then the last thing I just want to make sure folks realize too is that you have no control over this. And maybe that's not so different from a public market investment. Like if I buy a share of NVIDIA, I've got no control over what NVIDIA is going to do as a company. But you really have to, realize that I'm giving this guy on this speculative investor my money. And once I've given it to him, I have no control over what he's going to do with it. I just have to cross my fingers and hope, it's going to return what he was promised me it's going to return. So, all right.
Yeah. And so I think we kind of beat that horse.
I think we beat this horse to death too. But the point is we're not saying definitely don't do it. I would say that the times that I have invested, and it's been rare in private deals, I have done so in dialogue with my own personal financial advisors. Some of whom have sometimes brought a deal to me and said, hey, look, we get deals all the time. We generally don't look at them, but we've seen that a number of our investors whom are successful are investing in this deal here. And so maybe you might want to look at it, right? And that's a nice filter to have, right? Yeah. But again, like I said, you want to get yourself that type of competitive investor. All right, well, let's look. I've got a few charts I want to just let you react to as Lance the Eagle, right? And these may be a little bit more bearish on the bearish side. But then let's get to your recent piece about which I think is a little more bullish, which is this permanent shift in valuations that you think might be underway here. So really quick, let me see if I can pull these up here. Bear with me. This up. Oh, hey, one last thing on his accredited these private deals before I move on. You had said, Lance, that the accredited investor definition includes your primary residence in the $1 million requirement. It actually doesn't. That's
I know. After I said it, I was going to come back and correct myself, and I forgot. But yeah.
Okay, yeah, because I know people would probably picked up on that.
I misspoke. My bad.
No worries. Okay, so first off, this is the Bloomberg surprise index. And Lance, can you see the chart here?
I can.
Okay. All right. I'm good.
It's upside down, but yeah, yeah.
Okay. Well, it's basically showing that there is more downside surprises
Right.
now in the Bloomberg Surprise Index than we've seen since basically the start of 2019. So in the past 5 years, we were having more downside surprises in the past 5 years. I want to combine this with this other chart here, which essentially is showing that this is one of those charts like you were showing us that SimpleVisor has
Right.
for certain stocks, but this is showing the economy. And basically it shows that we've spent the past couple of quarters in recovery, but now actually the trajectory is crossing the borderline back into contraction. And so I guess my point is we're starting to see, some economic data here as the economy is slowing a bit. We had what was it, 1.3%, I think, adjusted post adjustment Q1 GDP growth. We're now starting to see some slowdown again. Q2 GDP looked like it was recovering, but it's now beginning to get pulled down again.
Right.
What are your thoughts right now on just sort of this macro data that's showing the economy is slowing?
So first of all, you got to be real careful with can you bring that Bloomberg Surprise Index back up? There's also one by Citigroup as well. They look very similar to each other. Yeah, that one. So everybody, you need to understand what this chart is, first of all. So what this is the differential between what economists were expecting versus what actually happened. So this is really just telling you how exuberant or how bearish economists are. And so what happens typically, if you go back to looking at 2017, back in 2017, we were all very exuberant about economic growth was fantastic. Earnings were going to be awesome. Everything was great. And then we got to 2018 and we launched trade wars with China and we did a whole variety of other things. And the Fed's talking about, potentially nowhere, the Fed was hiking rates at the time, but we're nowhere near neutral and everything kind of fell apart. Well, what happened, of course, is that as that line was going up, that was where everybody was very exuberant about things. And the data was even coming in better than even what the economists thought. Well, as that happens, economists do what? They start ratcheting up their expectations. So, they go into this year as a good example. When we were in 2022, economists all thought, what, Adam? Everybody believed on the economist side we were going to have a recession, right?
That's actually, absolutely, yeah.
Right. So coming out of 2022, the data started coming in better. All the economists thought we were going to have a recession, so the data came in better. So the economic surprise index was going up. Then analysts got super bullish, like, oh, definitely not going to have a recession anymore. We've having a soft landing. It's fantastic. And now so they've all ratcheted up their growth expectations for this year in particular. Earnings expectations are expected to grow by 20%. Goldman Sachs 6,300 on the S&P because of strong economic growth. And so all of a sudden, analysts are going, the data is disappointing those very exuberant, optimistic outlooks. So what will happen here is now, as we start getting into the next few months, analysts are going to start ratcheting down those expectations and we'll start getting surprises again. So this is really a measure of economist psychology more than it is of economic activity.
Okay.
Right?
That being said, the fact that it's at extreme low readings right now, does that make you think that, hey, that we're probably near a reversal in
Yes, this is
yeah,
we're going to start to see economists ratcheting down expectations. This will start to reverse and go higher again. And that's because it's a psychological measure. And again, there's, again, it's interesting. It just tells you that economists are way too optimistic right now about what's actually happening in the economy. And so we'll start to see a lot of these, instead of economists expecting, and again, you see this with the Atlanta Fed GDP now, was it 4%? Then it went to 1.8. Now it's about 2, a little closer to 3. It's come back up a bit. That's going to come back down again before the end of the quarter. So again, we'll just start to see all these analysts begin to adjust their outlooks for the end of this year. Is that, we're not going to have 3% economic growth in the economy this year. It might be closer to 1.8, 2%, which would be about normal.
Okay. All right. Well, look, uh, I've got one or two other things that might still be in the bearish camp, but I'm going to hold off on them for a second because I do want to get to your article here. So let's talk about why you think valuations might be, when we talk about like PE ratios, mean reverting, why the odds of that might be lower, or if they do, they might not revert as low as historic means would otherwise have us
Sure.
suggest.
Yeah, and this is something that we've talked about for a while. So this is so I've shown you this chart before, but over the last decade, really, well, actually since 2010, we've had a massive increase in the annual rate of return in stocks because of all this monetary intervention, zero interest rates, monetary fiscal policies, et cetera. I mean, we've had $45 trillion worth of money injected into the economy and the markets over the last since 2009, every type of bailout you can imagine. And this has created a lot of excess returns. And this goes back to investors and how they behave, is they're very confident about future returns. Now, historically and so this data is from New York University, and they have this data that they put out, started in 1928. I didn't cherry pick 1928. It just that was the start date of the data that they had, and this is total return. So this includes total real return. So this includes dividends and inflation. And so from 1928 to 2021, the average rate of return was 8.48%. So about 8.5%. So that is completely in line. You see these, analysts, you'll hear these stories about, oh, if you just invest in the market, you get a 10% annual rate of return. Well, that's 6% appreciation, 4% in dividends, right? Subtract that inflation of roughly 2, you get 8%. So that's how the 8% total real return comes around. We broke that up into some different phases. We said, 1928 to 1999, let's take out the whole bear market that began in 2000. So how did that look? Well, that was about 9.25%. 1972, you catch the bear market, and in 1972, you get the whole secular bull market through 2021. 8.13%. So no matter how you really break it out, it's all been roughly up to 2021. It's been roughly about 8%. Take a look at 2012, 2009 through present, and all of a sudden we're up 50% more than all the average return years going back through history. We're doing 12, 13% over that period of time. And this is because of all that liquidity injection that we put into the market. So of course, because of all that intervention, we have a lot of conversations about how elevated valuations are, and that we're going to have this massive mean reverting event. And so my question to myself was, okay, if we're going to do a mean reversion, what are we talking about, right? Because historically, we go back to 1974, when we did a mean reversion, we went from 23 times earnings to about 7 times earnings. 1928 went to 23 times earnings to about 5 times earnings. Those were massive mean reverting events, and they ranged, and valuations really kind of capped around 23 times earnings, and we bottomed around 5, 6, 7 times earnings. And that was your buy point, right? So you got down below 10 times earnings. That was really the time to buy, and you did great. But has any of that changed really since the turn of the century? So I started doing some analysis and saying, okay, let's just take a look at a couple of things. So first of all, so this is the historic return of the market. So this is the real S&P 500 index versus its exponential growth trend. And so going back through history, the markets generally traded close to their exponential growth trend, above and below it. So you had secular bull markets, secular bear markets trading above and below those secular growth trends. The dot-com crash, you got very elevated, obviously above that. Then you mean reverted that all the way through the financial crisis, went back below that exponential growth trend. And then since 2009, when basically the Fed became hyperactive, we've got such a massive deviation from the exponential growth trend that, yeah, you look at that, you're going to go, wow, that, whatever mean reverting event, it's going to be huge. We're going to have this is going to be a phenomenal crash when it occurs. But maybe, we're just talking about price here, but maybe that how do we kind of evaluate that? So this is kind of looking at so where do valuations come from? Valuations is price times earnings, and that's how we get to valuations. Well, over the last year or so, Wall Street has really been ramping up earnings expectations. We have a very big deviation in earnings from the long-term exponential growth trend in earnings. Normally, going back through history, if you look at each peak of earnings that occurred, with the exception of the current one, that was about a 6% growth rate in earnings peak to peak, which ironically aligns right with the earnings, with the capital appreciation of the market, about 6% over that period of time. So we've now deviated above that 6% trend line peak to peak. And so earnings are very exuberant that we're going to continue to kind of grow at an exponential rate. If we took a look at valuation measures, every measure except for equity risk premium is very above, is very much elevated above their long-term averages. So there's little argument that markets are overvalued. I don't think anybody's going to argue that markets are overvalued right now. So this is where we start to talk about kind of a permanent shift higher in valuations. Valuations are a function of psychology. In other words, are investors willing to pay more for ownership in equities than they were in the past? And there's a very high correlation between consumer confidence and trailing valuations. Shouldn't be surprising, because when everybody's very confident, they're willing to pay more for stocks because they think things are just going to keep going to the moon. When markets are crashing, they're not nearly as confident. So let's take a look at valuations currently as a deviation from their exponential growth trend. So remember, as we said earlier, going back through history, normally from 1900 through about 1980, peak valuations were around 23 times earnings. The bottom in valuations was about 5, 6, 7 times earnings. And so normally when you got 23 times earnings, you were very deviated above that long-term valuation growth trend of valuations over time. So valuations are constantly growing because, we have higher corporate profits, a stronger, the economy's growing. Markets are becoming, more liquid these days than they were in the past. So it's not surprising that there is a rising trend of valuations over time. And so in previous years, as you can see now, yes, we're currently trading at 33 times earnings, but the deviation from the long-term growth trend is only about 15%. We're not pushing 20 and 30% deviations above that long-term growth trend in valuations, because there's been a natural lift to that valuation growth trend over time. And the longer that we continue to maintain higher valuations, that growth trend in valuations is going to continue to elevate. So I said, okay, well, let's look at valuations going back historically and kind of view this change in dynamics of current valuations. So if we take just a median of valuations present all the way back through history, that's about 15.4 times earnings. So if you had a reversion back to the median, long-term median, we would revert from 33 times earnings today to roughly 15. Since 19, and you take a look at the Cape median. So, if we start looking at the Cape median since 2000, which is that kind of the orangish line, that is the current kind of median Cape valuation from 1980 to present. And if we look at the median, from 2000 to present, if we look at the median from 1980 to present, is 23 times earnings. So the median now from 1980 to present is where the peak of the valuations were going back all the way through history. So normally at 23 times earnings, you're like, oh my gosh, the market is extremely overvalued. But now that's just become the median since 1980. So a correction from 33 times earnings back to the median of 23 times earnings isn't as large as it would have been in previous history. So we can see that since really 1980, there's been this because markets have remained so elevated for so long, it's just kind of lifted the overall valuation of the market. So now when we start talking about a mean reverting event, this is going to be a little bit of a different exercise. So as we've talked about before, you have to look at, we really spend our time looking at things in terms of probabilities and possibilities. And so when we start looking at the probabilities and possibilities of mean reverting events, we've got to start stretching this out on kind of a normalistic bell curve and saying, okay, well, what's my probability of economic Armageddon, right? That's a 0.014% chance on a standardized bell curve. Probably a hard landing scenario or a strong growth scenario might be a much more realistic outcome that we're working with at the moment. Again, we can, financial crisis is starting to push out there. There's about a 2.14% chance of another financial crisis like we had in 2008. Doesn't mean it can't happen. It's just a bit more of a remote possibility. So if we start looking at kind of normalistic valuation reversions, we can start looking at valuations relative to what the current median is in this kind of post environment of accelerated asset prices, lower interest rates, monetary physical supports, all this type of thing. So we take those medians of the various periods that we just showed you a second ago. We say, okay, at 23 times earnings, and again, so when I wrote this article, the market was trading at 5,300, right? We're 5,400 now. So that's how fast we moved in a week. But so at 5,300 and looking at the valuation of earnings for the end of this year, currently earnings are expected to be $217 a share. So take those medians from above, 23.7 times valuations. That would be the correction from 33.4. That would be about a 3% decline, assuming, now this assumes that 5,300 is where the market is and 217 in earnings are met. So in other words, December 31st, we're 5,300 and 217. So in other words, the market didn't change price for the rest of this year and earnings go from 192 to 217, which is what's expected. That would put about a 3% decline in the market from 5,300. At 16.52 times earnings, which is now we're getting into a fairly sizable mean reversion of valuations, that's about a 33% decline. If we get back to the long-term median at 15 times earnings, that's a 38.5% decline. So again, there's a chart of what that would look like. So again, there's a risk here of a mean reverting event of more than 30% of the markets, and that would only get you back to where we were at the peak of the market going into 2020. So that's how far deviated that we've gotten from these long-term growth trends. And the market has a potential for a fairly significant correction. And here's the interesting thing about this. So this is the S&P. And again, at the time when I put this together, we were at 5,300. If we have a correction back to the bullish trend line that goes back to 2009, that would be a 38.49% correction. So the market could correct 40% from here, and it wouldn't even be a bear market.
It'd still be within its bullish trend.
Correct.
At the bottom of it, but
right. And that'd actually be a really healthy correction that you could probably buy. But this is just the point of this article is that even with this shift higher in valuations, the correction that is a potential is still fairly significant. I mean, if you lose 40% of your money, that's going to put a ding in your future portfolio, outcomes as to what's going on. So something we certainly shouldn't ignore by any stretch of the imagination, but just realize that, when we start talking about the financial crisis, that was terrible, right? That was a real bear market. We broke the bullish trend. We lost 52% of our portfolio values peak to trough. We could lose 40 and still be in a bull market. That's how far this last decade and a half of financial interventions, and this is why we were talking earlier about do-it-yourself investors. They are very, very confident in this market because of you just buy the dips because the Fed's going to bail everything out. This has been the story. Don't worry about overpaying for valuations because the Fed's going to be there to support everything. That's okay. That even in that premise, you can have a mean reverting event that will take 40% of your money away and still be in a bull market.
So it's interesting, Lance, when you started this, I thought you were going to be making the case that, okay, market's probably not going to pull back as much as many bears expect because we have this higher baseline now with valuations. Yeah. And I think that still may be the case, but, I think I'm taking even more away from this. You're saying, hey, despite that, I think that there's still a fair amount of correction risk in the market, just given
Yep.
the deviation we have from,
Well,
from that bullish baseline channel.
right. No, and look, the reason for this article is because, I've been getting a lot of emails about, oh, this market's gonna have this massive mean reverting event because we got to get back down to 7-8 times earnings. Maybe, but we haven't seen 7-8 times earnings since 1974. Doesn't mean we can't, right? But because what we have to look at is what would it be if we had a mean reverting event from 33 times Cape, and these are Cape valuations. So if we take a move from 33 times Cape back to 23 times Cape, you'll hear a lot of people say, well, the market's still expensive, right? You get to 16. Market's still expensive historically, going back to 2000, going back to 1900. 16 times earnings is still overvalued. And I think we've got to be careful now with saying the markets are overvalued at 33 times earnings. They are overvalued, but they may not be as overvalued as we would assume if we're expecting a valuation reversion back to the long-term mean. Because again, just the deviation from the long-term growth trend of valuations isn't nearly what it was back in 2000 when we were trading at 44 times valuations and we had nearly a your face is in the way, about 120% deviation from the long-term mean. Today we're trading, like I said earlier, we're trading about 15-20% from that deviation from that long-term valuation trend. So again, that valuation has risen. So in order to go through a valuation reversion process, the price correction can be fairly deep, assuming that earnings don't collapse, right? And again, this is assuming that earnings stay at 217. Next year, 2025, estimates on the S&P are $251 a share by next December. So that 217 to 251 next year, that's a huge increase in earnings. If the price of the market is flat at 5,300 and we go to $251 a share in earnings, our valuations will drop rather sharply and the price of the market doesn't change. So remember, there's two ways to reduce valuations. It's either a price correction as earnings fall or prices stay stable as earnings grow. And so I've got an article coming out we'll talk about next week, which is Goldman Sachs, their target of 6,300 by the end of this year. Is that really that unrealistic? And we start talking about, and that article focuses on valuations and what happens if earnings go up and we continue to have what we call a multiple expansion process versus a multiple contraction. This is about multiple contractions. What happens if we have multiple expansion?
Okay, got it. All right. So a couple of things I want the listeners to take from this, which is, Lance, your job is to be the eagle. Probably more on these discussions with me. You are trying to remind people that the market can continue powering higher. It generally tends to do that 85% of the time. So bears need to be cautious about being too conservative. That being said, sounds like you are, you still very much have an eye to the corrective potential of this market. And so, you're not a flag waving bull that just says, hey, throw caution to the wind, keep riding this thing because it's going to go to 6,300 tomorrow. You definitely pay an awful lot of attention in your day-to-day portfolio management of risk management, of the fact that this thing could drop 40% because of the data you showed us. And crazily, even if it did drop 40%, it technically wouldn't have broken into a bear market correction yet.
Exactly. It's going to feel like a bear market. But look, this conclusion that I wrote is the most important thing, right? This is just a thought experiment because, people talk about valuations and, mean reverting events and those type of things. And I certainly understand that. And so this is a what if scenario. And again, so part 2 of this article, it's not really a part 2, it's just a follow up about, what would it look like if earnings do reach, higher levels and things keep growing the way that Goldman Sachs expects them to grow. Is 6,300 really unreasonable? And so we'll do the other half of this article next week. But the conclusion is important, right? This is just a thought experiment. 2 critical takeaways. The deviation from long-term means is extreme, suggesting a more significant decline is possible in the future. And While valuations are elevated relative to long-term history, if there has been a permanent shift in valuations, the subsequent correction may not be as deep as some expect. Importantly, investors repeatedly make the same mistake of dismissing valuations in the short term because there's no immediate impact on the price of returns. As noted, valuations by their very nature are horrible predictors of 12-month returns. Therefore, investors should avoid any investment strategy that has such a focus. However, in the longer term, valuations are excellent predictor of expected returns. From current valuation levels, expected rates of return over the next decade will be lower than it was over the past decade. In other words, not 12 to 15%, probably closer to 6 to 8%. That is, of course, unless the Federal Reserve and the government launch another massive round of monetary stimulus and cut interest rates to zero. That doesn't mean that the markets will be single digit every single year. There's going to be some great years, and there's just going to be some really poor years somewhere along that path over the next decade that brings that rate of return lower. So you have to manage your cycles and manage your portfolio accordingly.
All right, got it. And this is somewhat of the Hussman argument, which is that, the market is at a level of valuation that by his calculations, the overall return over the next 12 years, I think it's even negative, but it doesn't mean that the market's going to be, tabletop flat or just slightly make its way to negative. It probably will ping pong around. Overall returns are expected to be lower than they've been in the previous decade. It seems like you feel the same thing, but, from an active management standpoint, especially if you can be good at the risk management part and limiting your vulnerabilities to the downsides, there can be some great opportunities that get provided along the way to ride the upsides. Correct?
Yeah, and it's absolutely right. It's just, and again, this is really important that, if you're talking with your advisor and it's like, well, we're not owning stocks right now because valuations are just too high. That can last a very, very long time, and you're going to miss a lot of market returns. Again, valuations have no predictive capability over 12-month returns. So we have to, as we always talk about, we got to trade the market we have, but understand the risk that high valuations do have a longer term impact. And there will be a price to pay for the last decades of monetary interventions, unless we keep doing it. Right. And $43 trillion from 2009 to present. If we do another 43 trillion, don't know how, but if we're going to keep doing HAMPs and HARPs and TARPs and in stimulus checks and all this other stuff, then this market's going to continue to power higher.
Well, and confidence in that is high. And that's, I think a reason a lot of people are long the market, where they just think, it's the Fed put. We can call it the Fed and fiscal put at this point in time, right? And that is something that I think is worth noting, Lance, which is, it's another argument to not just be out of the market completely, which is if the status quo continues in terms of what's changed over the past couple of decades to get us to this higher valuations, huge part of that's been intervention. It's been excess liquidity that's been pumped in, right? And the cost of that, there's no free lunch, right? Mm-hmm. And the cost of that is in the purchasing power of the currency, right? And in those type of environments, you have to find ways to grow your wealth over time, or else it's getting eroded by that loss of purchasing power in the currency. So if you're just sitting there in cash, and this is what was terrible up until just a couple of years ago for those that were sitting in cash, is you were getting no return in the cash as well, right? Technically, now you're getting a real return if you believe that CPI is an accurate measurement of the decrease in purchasing power. But the thing is that, sitting on the sidelines does have a really expensive cost in this environment where it's excess liquidity that's driving everything and eroding the value of your purchasing power down. Yeah. And again, look, I'm not advising folks not to be conservative if they have concerns, and full transparency, I lean much more on the conservative side, but I'm not 100% out of the market. Yeah, but I'm not 100% out of the market for in large part for this reason that I'm talking about. Yeah. Okay. Let's see here. We got to start wrapping it up. I want to get to your trades in just a minute. I want to bring in a couple quick points of view though. One is I just recorded an interview with Joanne Shu, who is the research director at the University of Michigan for computing the consumer sentiment charts. And that was a really interesting discussion, Lance. Just getting to hear from the person who actually puts together that data, you know, what their sense of consumer sentiment is right now. And basically her story was, you know, sentiment, it isn't fantastic, but it's not doing terribly. But the results are really bifurcated. So, you know, you've got the top tercile that's not worried at all. But you've got the bottom two terciles, the middle and the bottom, that are increasingly saying inflation's killing me. I'm not keeping up with the higher cost of living. And that does seem to be at an extreme and continuing to worsen right now. I want to connect that to a recent headline that just came out, a survey that was just done by Natexis, that it says that, hey, Gen X, believe it or not, Lance, is beginning to approach retirement age. And this really is the first generation that the experiment of, you know what, doing away with corporate pensions, but good news, you guys are in control of your retirement destiny. We're going to give you these self-directed retirement accounts to, you know, diligently put your money away in. And we're now beginning to see how that experiment ended. And it's not looking great. And, you know, it's over half of Gen X says it's going to, quote, take a miracle for them to be able to afford retirement. And a full 40% of Gen Xers have $0 saved in a retirement account.
Well, you and I have talked about, you know, the travesty of all this.
Exactly. And look, boomers, I mean, despite having a crap ton of the wealth, you know, the boomers don't look a ton better when you look at it at a median versus a mean way. But Gen X is definitely looking worse, and I'm sure it's going to be even worse for the lower generations. But anyways, my point is you know, that's a train that's going to take a while to arrive. You know, the Gen X retirement crisis, more acute right now is people really struggling under inflation. But the trends are the same, which is this struggling consumer. And of course, we're beginning to see even more data now that's showing this. We've talked about the explosion in revolving credit and people having to rely on credit cards more and more to fund life events. But the latest retail sales data, again, you know, is looking weaker and weaker. And I think that's beginning to really show the consumer is in the process, it looks like, of tapping out. So, you know, but we've got a market that seems to not care about any of this stuff, right? And I'll wrap this up in a second, but the last piece of the puzzle I want to bring in here is the interview that I did with Fred Hickey, high-tech strategist, who I knew he was skeptical of the prospects for AI relative to the tremendous amount of spend that's going on there, and certainly relative to the trillions in market cap that have been added on the promise of AI. Wow, did I underestimate his level of skepticism? And you know, so much of this market right now is powered by so few stocks that the unifying theme that they have is AI. And Fred is basically saying, like, look, you know, he has followed the tech industry. He's a highly respected analyst. He's been following it since the 80s. He's seen tech booms and busts. He's seen tech fads come and go. Not that AI is a fad, but he's like, look, we've had AI for a long time. It is adding to our productivity. There's a lot of benefits it's giving us and will continue to give it to us. But this whole generative AI mania that's going on right now is evolutionary. It's not revolutionary. You know, it's not the kind of thing that's going to be adding, you know, an incredible amount of productivity to the economy overnight. And increasingly, we're seeing, you know, the spend continue to mount, hundreds and hundreds of billions being spent on this technology. But the incrementally new revenues that we're seeing from it are marginal right now. And one of the stats he threw out was, yeah, they've sort of attributed like 5 billion in incremental new revenue to AI versus the hundreds and hundreds of billions that's been spent over the past year and a half. And granted, you know, that's an investment, and we'll see more return on that over time. But he's basically saying he's seeing more and more companies now saying, like, whoa, wait a minute, like we were expecting more by now. And we're now really questioning whether we want to keep spending like this. And he said the VC community spent $500 million in 2023 on investments in AI startups. He said they've ratcheted that down 75% since, which is like, hey, even the big tech investors are beginning to really pull their money from here. So if they do, right, and we have the spigot of just unrelenting capital, capex going into companies like NVIDIA, if that really starts turning off, you then potentially have the cascade function of revenue expectations for NVIDIA go down. So then NVIDIA stock gets hammered, right? And then all the ETFs that own NVIDIA get hammered, right? And then the companies in this space, really start retracting. And then this weakening economy that we already talked about, and weakening consumer I talked about, then you get the knock-on effects in the real economy from that. And then people start getting laid off, and then consumer spending goes down, and then the whole thing really starts. So like, how concerned are you as a capital manager right now playing this game of, hey, you got to be invested and whatnot, but when so much of the market is in so few of these companies that have that potential risk looming out there?
Well, no, it's a big risk. So XLK, which is the Spider ETF technology ETF, is doing a rebalance. And so they have investment rules that drive their weightings in their portfolios. So according to their investment policy, they cannot have a concentration risk in a very small number of stocks. So 2 stocks, according to their investment policy, have 20% weightings in the portfolio. Everything else that they own is 6%, 5%, 4, 3, 2, 2, 2, 2, 2, right? So it gets pretty small down the list. So right now, Apple and Microsoft both make up those 20, there's a little bit more than 20%, but they both make up 20% of the XLK ETF. NVIDIA is a 6% weight. Today, I think it's either today or next Friday. I can't remember the exact date, but I think it's today on Friday. That weighting will switch. NVIDIA will become 20% of XLK. Apple will go to 4.5. So all of a sudden, if you have, and again, this is always ironic because this is about the time it happens of, the S&P 500 added super microcomputers, SMCI, right? It was a small cap company. S&P added it to the large cap index and it went down 30%. So, these indexes are typically very late adding stuff to their portfolios. And this kind of all feeds into the overall psychology of the market, what's happening. I wrote an article on Tuesday talking about the New York Federal Reserve. They have a index that shows consumer sentiment towards stock prices. And so what I did was it's a very volatile index. So I ran an annual percentage change in the mean probability that US stock prices will be higher in 12 months. That index is reaching a very high level relative to history. Last time we were there was 2017, 2018. Then the markets declined 20%. And of course, 2019, everybody's going crazy over stocks. And then we shut down the economy. And now we're having the AI rush. And interestingly enough, so Yahoo Finance came out and said, well, that just goes to show you the wealth gap. See, the rich people are all, getting very excited over stocks, but, most people don't have any money, so they're not really invested in the markets. And that's really not, and again, we agree with that, right? 90% of the market's owned by, top 10% of investors. But what was interesting is that the biggest increases in stock sentiment by age is by people that are younger. And that's not surprising, right? You've got Robinhood apps, you have, Reddit channels, and everybody else talking about GameStop and NVIDIA. So I gotta go buy it. But not just ages, also income brackets. The lowest income brackets are having the biggest increases in sentiment going out to next year. So, the people with the least amount of money to lose are getting the most aggressive in the financial markets as this NVIDIA AI chase kind of dominates the entire market. So, obviously this, is going to work out badly at some point because these are the people that typically make the worst investments. You can read the rest of the article, but household equity allocations are at the highest level they've been since 2020. So again, we're at points to where, exuberance into the markets over this whole AI mania is really beyond what the markets can bear. And there's an old German proverb about how trees can't grow to the sky. And that's eventually kind of where we're going to be, is at some point that we've kind of reached this level of exuberance that, markets can't really just, handle. And, the earnings will never get there for NVIDIA, and there will be a big correction. And, you're going to lose 20, 30, 40, 50% of the stock value in NVIDIA. That's going to happen. And that's why we talk about regularly, take profits, reduce exposure. We reduced exposure to NVIDIA before earnings, and we dropped it back to a target weight of 2% in our portfolio. It's now 3% because it just keeps going up, right? So we'll have to trim it back again. But, we do that on a regular basis to to make money, right? You don't make money till you sell something. It's great to own something that's going up in value, but it's all fake money until you sell it. So, have a regular process of taking those gains, actually creating wealth for yourself, reinvest that wealth somewhere else. Don't keep concentrating into the same handful of stocks that are going up with the market. Diversify your portfolio. There's some other opportunities. We bought some energy stocks, when they were at their lows. We've had a nice little rally in those stocks lately. So there's other areas of the market. A big winner for us is a company you don't ever hear about, Costco, right? People are shopping there all the time and paying membership fees. That stock
we all hear about it because we hear about it from you every week.
Well, I know, but not every week. But I mean, those are stocks that don't get a lot of headline risk, but they're making you money. So, it's important. Fred's right that the expectations for generative AI are probably well ahead of whatever comes out. But this is always the case. This is what with the dot-com bubble. Dot-com was going to change everything. It was going to increase productivity. And we said, back then we were saying that's not going to be the case because it's going to displace a lot of labor. And everybody was like, oh, well, yeah, but that labor will go start programming websites and .com. Right. So you may lose your job, but you can still go do something in technology. Well, that doesn't really happen that way. And then, of course, you do get a lot of people that start programming websites, and the salaries fall because now you've got a glut of labor that can do this one particular task that you don't need anymore. I just saw an article, out yesterday or a couple of days ago. Jobs in the AI space are paying $300,000 a year because there's a shortage of people in AI. There'll eventually be a glut of people in AI, and those salaries will fall to $40,000 or $50,000 a year. If you can program AI, it's in 10 years, everybody's going to be doing it, right? Or more importantly, AI will be programming itself by that point, and you won't need programmers. So the question is, what does that do for the economy? What does that do for earnings potential? What does that do for the growth of the market, growth of wages? And that trend has been clearly lower. As we get more technology and more productive, we're getting lower wages, lower job performance, in terms of, people getting jobs. They're lower tier jobs. And we're continuing to shove more and more people in that path. The good thing is we're seeing a lot of people now going back to trade skills, going, hey, you know what, I can make money doing a trade. And that's something that AI can't do yet, right? AI can't do trades yet. But again, we haven't got robots there, but Elon Musk is working on that part. So we'll see.
All right. So I'm going to wrap it up, but I wouldn't mind maybe next time digging a little bit more deeply into two sides of AI. One is, look, let's assume Ted's right for a second. Fred's right for a second. And
I think he is, by the way.
The bloom really comes hard off of generative AI, right? So I mentioned, NVIDIA is going to get crushed, but also, a lot of the other Mag 5 are going to get crushed because a huge amount of their recent market cap gains are all coming from this, right?
That's correct.
We've got 3 companies that combined are worth $10 trillion right now, right? More than the entire Chinese stock market, right? Just 3 companies. And we only, I think the first $1 trillion company was Apple, and that was only back in 2018. It wasn't that long ago, right? So a lot
now
of
it's
that
3.
Yeah, now it's 3. And a lot of that market cap of the combined 10 trillion is expectations around generative AI, right? So if that were to kind of vaporize, some material percentage of that were kind of vaporize in a short period of time, what would that do to markets? And what would that do? What would the knock-on effects do to the economy? So it's a longer discussion. So let's put that for next week.
Yeah, and just by the way, NVIDIA is now the largest market cap company in the world.
Yeah, so it's finally got there. Right?
They overtook Microsoft last week. So
and not for nothing, because people do try to make some comparisons back to the dot-com era in terms of what's going on now. I think even I put out headlines that I saw going around last week where it was, last week NVIDIA surpassed Microsoft as the most valuable company. There are headlines from 24 years ago where Cisco passed Microsoft to be the number one market cap company. So people are seeing, comparisons of like, okay, we saw the hot stock displace Microsoft 2 decades ago, and then everything went to hell in a handbasket. Is the same thing going to happen this time around? Who knows? Right. We'll track it here. But the other part of the discussion I want to explore with you too is the labor side, right? Which is, let's assume AI does what they tell us it's going to do. Is it really a utopia where we all have, more time in the day to indulge in intellectual pursuits, or are we creating a massive under/unemployment problem that may have a higher cost than the benefits that we get from the technology? Right?
Yeah, I thought the greatest meme that I've seen on that lately is I thought AI would do my laundry and my dishes so I could spend more time doing art and music, but apparently AI is going to do art and music, so I have more time to do laundry and dishes.
Well, it's so funny. There's two things. One is we've talked about this. There's the problem that economists call technological displacement, which if you displace labor at a faster rate than you can repurpose it to other constructive use, you create a social problem bigger than the benefits of the technology. But also there's this driving assumption that if we give people more time and more leisure, that they will use it for more noble pursuits. And I think the jury is totally in on that. Like, the more we give people the ability to like learn for free of all the world's knowledge and whatnot, the dumber we get. The more we spend it on, cat videos and
video game
tracking and So I think there's a lot of flawed assumptions in this whole thing. And then of course you bring the MMT argument into that, which is like, well, we'll give people money and they won't have to work, and they can, they can take this free money and use it to better themselves. And it's like, in almost every case, we just use it to make everything worse for everybody.
Yeah.
But we'll dive into that last time.
Absolutely.
Okay.
By the way, just so you don't get a bunch of emails and I don't get a bunch of emails, NVIDIA is actually corrected for the last couple of days. So it may have slipped back into number 2 position. It had just crouched over Microsoft, but it's right there. So again.
Yeah. And not for nothing. I mean, it lost what, like 3.5%?
Yesterday? It's down 4. It's as of Friday when we're talking right now, it's down about 4% today. So
another 4.
Yeah.
That's a pretty big, that's a lot of market cap gone. And
but I mean, you're talking about a 10% correction. That's, this stock can correct 20% easy, right?
Oh, yeah.
It won't change a thing about its trend at the moment. So,
okay. All right. Well, look, as we wrap up here, trades. What trades, if any, of you guys made?
Didn't do any. Last trades we did were last week, and we talked about those. But we didn't do anything this week. Portfolios, and again, this has been a very boring week. And again, a lot of the movement in NVIDIA over the last 2 days is options expiration driven. So again, there's a lot of calls, a lot of puts on NVIDIA. So as those things get unwound and redone, et cetera, that's just putting a lot of pressure on the stock right now.
Right. So or everybody listened to Fred Hickey's interview and they're now.
Could be that too. But yeah, so, just don't pay a lot of attention to what's happening today. One thing that we're exploring right now is buying some out of the money puts in our options portfolio for kind of for the election. So maybe we're looking at writing some covered calls on the S&P and buying some puts on the S&P for November. Just try to get us through that election period.
So they're S&P puts. You're not putting on individual companies. You're doing on the
we'll just short the whole index as a hedge against our other portfolio positions. As part of it, we may sell other positions as well if the market really starts to deteriorate and we start to see that correction actually occur. But this will just help provide a little bit of a buffer for the portfolio. So we're talking about that. We haven't done anything yet, but in our base model, our 60/40 allocation, we're a little bit underweight equity. We're underweight our duration in bonds. We're a little bit overweight in cash. So we're kind of in a good position right now. We've been tracking our benchmark index very closely. Even being overweight cash and underweight equities and underweight duration in bonds, we're still tracking our index. So we've got the right positioning. So hasn't really needed to be a lot of changes at the moment.
Okay. All right. Well, look, I had an uplifting story for our end rant, Lance, but we'll have to save it for next time. But the Yeah. Anyway, so we'll do that. The end amount of it is why it's important to bet on yourself. So if you can maybe help remember to remind me next time,
Yep.
we'll save that one.
Okay.
All right. But otherwise, folks, look, if you feel that the best bet that you can make besides betting on yourself is watching Lance Roberts every week in these weekly market recaps, please let him know by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. And I think we are getting pretty close. I think we're just about 5,000 subscribers away from hitting the 100,000 subscriber mark on this channel. So if you're watching and haven't subscribed yet, please help us hit that milestone by hitting that subscribe button. You know, I think Lance and I spent a lot of time talking about the uncertainties in today's markets. And so, you know, I'm going to say same thing I say every week, which is unless you have a really good track record as a successful DIY investor, highly recommend that you navigate what's the road that lies ahead by working under the guidance of a good financial advisor, but certainly one that takes into account all the issues that we've talked about here. Look, if you're a DIY investor, I'm not trying to talk you out of that at all. But you want to make sure that you've got really good quality inputs in that. And we started off this video talking about Lance's SimpleVisor service, the new one that just launched. If you're unfamiliar with that, go watch the video we did last week. But if you're interested in signing up for the service, and it is, I think, the best deal on the planet, because it's essentially a Bloomberg, right? Which, you know, I pulled up the stats when we were talking last week, is about $2,000 a month. This is what, Lance, around
$29.95.
$29.95 a month. Okay, right. It doesn't even compare. But anyways, so whether you're interested in learning about the SimpleVisor service, or maybe signing up for it, or whether you want to talk with a good financial advisor, again, if you've got one who's doing all this for you, great, stick with them, work with them. But if not, consider talking to one of the ones that Thoughtful Money advises. These are the endorses. These are the folks that you see on this channel with me week after week. Perhaps you might even want to talk with Lance himself and the team there in RIA. To set up one of those free consultations, just go to thoughtfulmoney.com, fill out the short form there, and the folks, the advisors will be in touch with you within 24 hours to schedule a time to talk. All right, Lance, well, look, another great week. Thanks so much for recording early with me, because I now got to hop off to get to this panel, go ring the bell. If there's a clip, we'll show it next week for folks. But should be really fun. Again, I appreciate all the time and effort you put into this. Everybody else, thanks so much for watching.